Preparing for a risk management at JPMorgan Chase Co interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How would you define risk management in the context of JPMorgan Chase? Risk management is the discipline of taking informed risk, not avoiding risk completely. At JPMorgan Chase, I would think about it across credit, market, liquidity, operational, compliance, and reputational risks. The goal is to support profitable client activity while protecting the firm, depositors, shareholders, and the financial system. That means setting risk appetite, using strong analytics, escalating issues early, and maintaining controls that work in both normal and stressed markets. While answering, focus on identifying, measuring, monitoring, and controlling risk across businesses. Connect the answer to JPMorgan's scale, client franchise, regulatory expectations, and fortress balance sheet mindset. Question 2. What are the main types of risk a large bank like JPMorgan Chase faces? A large bank faces interconnected risks. Credit risk comes from borrowers or counterparties failing to pay. Market risk comes from movements in rates, FX, equities, commodities, and credit spreads. Liquidity risk is the inability to fund obligations or meet outflows. Operational risk includes failed processes, fraud, cyber events, and human error. There is also model, compliance, legal, and reputational risk. In practice, one event can trigger several risks at once, so governance matters. Make sure to cover credit, market, liquidity, operational, model, compliance, legal, and reputational risk. Explain briefly how each can arise in a universal bank with consumer, commercial, and investment banking activities. Question 3. Walk me through how you would assess the credit risk of a corporate borrower. I would start with the borrower's business model and industry, then move to financial capacity. I would analyze revenue stability, margins, leverage, interest coverage, free cash flow, liquidity, and debt maturity profile. Then, I would assess collateral, covenant protection, management quality, and ownership support. I would also run downside scenarios, such as margin compression or lower sales, to see whether the borrower can still service debt. The key question is repayment capacity under stress. In your answer, talk about business model, industry position, financial statements, leverage, cash flow, collateral, covenants, management quality, ratings, downside cases, and repayment sources. Question 4. What is expected loss, and how do PD, LGD, and EAD fit together? Expected loss estimates the average credit loss a bank anticipates over a defined period. The basic formula is PD multiplied by LGD multiplied by EAD. PD is the likelihood the borrower defaults, LGD is the percentage loss after recoveries, and EAD is the exposure outstanding at default. For example, a 2% PD, 40% LGD, and $10 million EAD gives an $80,000 expected loss. It informs pricing, reserves, and portfolio risk appetite. Be sure to mention probability of default, loss given default, exposure at default, and the expected loss formula. Include how the concept supports pricing, provisioning, capital, and portfolio monitoring. Question 5. How is market risk different from credit risk? Market risk is driven by changes in market prices, while credit risk is driven by a borrower's or counterparty's ability to meet obligations. If rates rise and a bond position loses value, that is market risk. If the bond issuer cannot repay principal or interest, that is credit risk. In a trading environment, market risk is monitored through sensitivities, VaR, stress tests, and limits. Credit risk tends to focus more on default probability and recovery. While answering, distinguish price movement risk from counterparty repayment risk. Cover trading books, interest rates, FX, spreads, equities, commodities, valuation changes, and how losses are measured daily. Question 6. Explain value at risk. What are its limitations? VAR estimates the potential loss on a portfolio over a given time horizon at a specified confidence level. A one-day 99% VAR of $10 million means losses should exceed $10 million on roughly 1% of trading days. assuming the model holds. Its limitation is that it does not show how bad losses can be beyond that threshold. It can also understate risk in illiquid or fast-changing markets, so stress testing is essential. Make sure to define VAR using confidence level, time horizon, and potential loss. Then discuss assumptions, historical data dependency, tail risk, liquidity gaps, and why stress testing complements it. Question 7. How would you explain stress testing to a senior manager? Stress testing asks what could happen if conditions become severely adverse. Instead of relying only on recent history, we shock variables like unemployment, GEP, rates, credit spreads, housing prices, or market liquidity. For a bank, the results show potential losses, capital pressure, liquidity needs, and business vulnerabilities. At JPMorgan, this supports regulatory processes like CCAR, but more importantly, it helps management decide limits, hedges, reserves, and contingency actions before stress arrives. In your answer, explain stress testing as forward-looking scenario analysis. Mention macroeconomic shocks, portfolio vulnerabilities, capital planning, liquidity planning, CCAR, and management actions under severe but plausible conditions. Question 8. What does risk appetite mean, and why is it important? Risk appetite defines how much risk the firm is willing to take to achieve its strategy. It is translated into limits, thresholds, concentration guidelines, and escalation processes. For example, a bank may cap exposure to a sector, country, rating category, or trading risk factor. It matters because businesses naturally pursue revenue, while risk appetite keeps growth within the firm's capital, liquidity, operational, and reputational capacity. Good risk appetite is practical, measurable, and actively enforced. Be sure to cover the firm's willingness to accept risk, quantitative limits, qualitative principles, governance, escalation triggers, business alignment, and how risk appetite prevents excessive concentration or uncontrolled growth. Question 9. Tell me about the 3 lines of defense model in risk management. The 3 lines of defense clarify accountability. The first line is the business, which owns the risk because it originates transactions, serves clients, and runs processes. The second line is independent risk and compliance, which sets frameworks, challenges decisions, monitors exposures, and escalates concerns. The third line is internal audit, which independently tests whether controls and governance are effective. The model works only when the first line takes ownership and the second line has real authority. While answering, identify the business as first line, independent risk and compliance as second line, and internal audit as third line. Explain ownership, challenge, oversight, and assurance responsibilities. Question 10. If a business wants to approve a profitable transaction that exceeds risk limits, what would you do? I would not treat the limit as a formality. First, I would understand why the transaction breaches the limit, whether the exposure is temporary or structural, and what the downside looks like. Then I would assess mitigants such as collateral, hedging, tenor reduction, or smaller sizing. If the deal still makes sense, I would escalate through the approved governance process with clear documentation. If it falls outside risk appetite, I would recommend declining or restructuring it. Make sure to show commercial awareness without ignoring controls. Discuss understanding the breach, materiality, compensating factors, escalation, temporary approvals, documentation, and whether the trade fits risk appetite. Question 11. How would you identify concentration risk in a loan portfolio? I would aggregate exposures across several dimensions, not just by individual borrower. Concentration can appear by industry, geography, sponsor, collateral type, rating grade, maturity, or macro driver. For example, separate real estate borrowers may still share the same exposure to higher rates and lower property values. I would compare concentrations against limits, run stress scenarios, and review whether returns compensate for the risk. Diversification only helps when exposures are not highly correlated. In your answer, talk about exposure aggregation by borrower, sector, geography, rating, collateral type, product, maturity, and correlated drivers. Include limits, stress testing, and diversification analysis. Question 12. What is counterparty credit risk, and where is it most relevant? Counterparty credit risk is the risk that a trading counterparty defaults before settling its obligations. It is especially relevant in derivatives, repos, securities lending, and prime brokerage. The exposure is not just today's mark-to-market, it also includes potential future exposure if markets move. Risk is managed with netting agreements, collateral, margin calls, credit support annexes, limits, and central clearing where appropriate. A key concern is wrong-way risk, where exposure rises as counterparty credit quality worsens. Be sure to explain exposure from derivatives, securities financing, and trading relationships. Mention replacement cost, potential future exposure, netting, collateral, margining, wrong-way risk, and central clearing. Question 13. How do rising interest rates affect a bank's risk profile? Rising rates can help a bank by increasing asset yields and net interest income, but the risk picture is mixed. Funding costs may rise if depositors demand higher rates or move to alternatives. Fixed-rate securities can lose value, creating valuation pressure. Borrowers with floating-rate debt may face weaker coverage and higher default risk. Mortgage volumes can slow. Asset liability management becomes critical because the bank must manage earnings, liquidity, duration, and credit quality at the same time. While answering, cover both benefits and risks: net interest income, deposit behavior, bond portfolio values, borrower stress, mortgage activity, funding costs, liquidity, and asset liability management. Question 14. What is operational risk, and how would you manage it? Operational risk is the risk of loss from failed processes, people, systems, or external events. In a bank, that could be payment errors, trade booking issues, fraud, cyber incidents, vendor failures, or regulatory process breakdowns. I would manage it through strong controls, segregation of duties, reconciliations, key risk indicators, risk and control self-assessments, incident tracking, and root cause analysis. The goal is not only to fix issues, but to prevent repeat failures at scale. Make sure to define operational risk from failed processes, systems, people, or external events. Include controls, incident reporting, KRIs, RCSAs, business continuity, cyber risk, and root cause remediation. Question 15. How would you handle a situation where data quality issues affect a risk report? I would first determine whether the issue affects decisions, limits, regulatory reporting, or senior management reporting. If it is material, I would flag it quickly rather than let users rely on bad numbers. Then I would reconcile to source systems, quantify the impact, and apply temporary controls or adjustments if appropriate. I would communicate clearly what is reliable and what is not. Afterward, I would support root cause remediation so the issue does not recur. In your answer, emphasize urgency, transparency, validation, impact assessment, stakeholder communication, temporary controls, root cause analysis, and remediation. Avoid pretending the report can be used without qualification. Question 16. What is model risk, and why does it matter in banking? Model risk is the risk of loss or poor decisions because a model is incorrect, misused, or poorly implemented. Banks rely on models for credit scoring, pricing, stress testing, capital, fraud detection, and valuation. If assumptions are wrong or data is weak, the output can look precise but be misleading. That is why independent model validation, backtesting, performance monitoring, documentation, and change control matter. The strong bank challenges models rather than treating them as black boxes. Be sure to explain that models can be wrong due to assumptions, data, methodology, implementation, or misuse. Mention validation, backtesting, monitoring, governance, and regulatory scrutiny. Question 17. Describe how Basel capital requirements influence bank risk management. Basel requirements force banks to hold capital against risk. Assets and exposures receive risk weights, and the bank must maintain ratios such as Common Equity Tier 1 against risk-weighted assets, plus leverage and buffer requirements. This influences which businesses consume scarce capital and whether returns are attractive after capital costs. For risk managers, Basel is not just compliance. It affects pricing, portfolio construction, balance sheet strategy, and resilience under stress. While answering, cover regulatory capital, risk-weighted assets, CET1, leverage ratio, buffers, stress capital, and how capital requirements shape pricing, portfolio strategy, and balance sheet allocation. Question 18. Give an example of how reputational risk can become financial risk. Reputational risk becomes financial risk when trust breaks down. For example, if a bank mishandles customer accounts or fails to meet compliance obligations, the immediate issue may be operational or legal. But the downstream effects can include customer departures, lower new business, regulatory fines, litigation, higher funding scrutiny, and management distraction. In banking, trust is part of the product. That is why conduct, controls, and escalation are financially material, not just ethical concerns. Make sure to connect reputational damage to client attrition, legal costs, regulatory penalties, funding pressure, revenue loss, and management distraction. Use a practical banking example. Question 19. How would you prioritize multiple risk issues at the same time? I would prioritize based on materiality and urgency. Issues affecting client money, regulatory reporting, liquidity, capital, or active limit breaches would move to the top. I would also consider likelihood, financial exposure, control weakness, and reputational impact. Then I would separate immediate containment from long-term remediation. For example, a manual control may temporarily reduce risk while technology fixes are built. Clear ownership, deadlines, escalation, and status tracking are essential when several issues compete for attention. In your answer, discuss materiality, urgency, regulatory impact, client impact, financial exposure, likelihood, control weakness, senior escalation, and balancing quick containment with durable remediation. Question 20. Why do you want to work in risk management at JPMorgan Chase? I am attracted to risk management because it sits at the intersection of analytics, judgment, and business decision-making. JPMorgan Chase is especially compelling because of its scale, diversified franchise, and emphasis on disciplined risk culture. The decisions made in risk affect clients, capital, liquidity, and the firm's reputation. I want a role where I can analyze complex exposures, challenge assumptions, and help the business grow responsibly while learning from a highly sophisticated risk organization. Be sure to make the answers specific to JPMorgan's scale, risk culture, diversified businesses, data-driven decision-making, client impact, and learning opportunity. Avoid generic praise without linking to the role. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.